I'm Deborah Borchardt, and this is your midday market update. Well, we started out the morning definitely in the red territory. We are still there, all because of this government shutdown that is looming later today. However, our losses are getting trimmed, and joining me now is Mark Newton from Greywolf. So, Mark, you're a technician. You know, we opened down like, 170? We're only down around 100 points right now, and it does look like buyers are starting to pick up some bargains.
You can't really make much of this bounce so far, Deborah. I mean, if you look, this is very similar to what we saw in early August, right after the Fed meeting, where, you know, the market popped for a day, and then we had nearly 3 or 4 weeks of weakness after the QE, and now they said it's not going to be taken away anytime soon, and people still feel like there's a lot of confusion, more confusion than clarity right now with regards to what the Fed's saying. So some of the selling could be partially attributed to threat of a government shutdown, but the market did peak out on the 18th of September. And so my thinking is we're going to continue to see volatility. There's a lot of uncertainty regarding not only the debt ceiling talks and the government shutdown, and Obamacare starting. You know, there's a lot to worry about. We're still seasonally in a very bearish time of the year, being September, October. Momentum has turned negative. Today's break below 1685 and the S&P is a short-term negative. It means the market probably gets down to 1655 to 1660 in the short run. We can't afford to take out August lows without thinking we have a bigger pullback in store, which a lot of people would say is a long time coming. I mean, technicals have been negative on the market really for the last few months. If you look at things like waning momentum, fewer stocks hitting new highs, sentiment has gotten extremely bullish. So there are a few things that are concerned. The trend at this point is still positive on a longer term basis, but you know, the recent break is sort of bringing things back in reality and saying that, you know, yes, the market can go down. It doesn't simply have to go up every day like the last few months have taught people.
What's that August low that you're looking at?
Right near 1627 to 1631, depending if you look at S&P futures or cash. But really under 1630 on a close would be very negative for the market, really going into October and thinking we can have a much bigger sell-off that potentially could be 7 to 10% before we probably stabilize and have a year-end rally. But we're certainly in a position where the markets, I think, are still vulnerable in the near term.
All right, well, it sounds like Mark got his bear cap on right now because he's feeling very bearish. And we're going to keep our eye out on that line in the sand that he's given us, so that if they do break below that, we could really have to put on the hard hats. That's Mark Newton from Greywolf, and I'm Deborah Borchardt with TheStreet.